Welcome back, everyone, to the NFT Nation podcast, the most relatable and reliable NFT and crypto podcast in the nation. And in today's episode, I will be explaining what a stablecoin is and why they are so important inside the world of crypto. So, without further ado, let's just hop right into it. So, have you ever wanted to invest in crypto and you don't want to have the value, in the volatility of that, like crypto is? So that's what kind of stable coins are all about. And if you still want to be able to transfer your money around the crypto space while having it stay pretty much the same amount and not rise or fall within the crypto space, this is what stable coins are here to do. So, some cryptos were meant to be a means of exchange instead of a store of value, and a means of exchange would be like a stablecoin, and a store of value would be something like Bitcoin. But these stablecoins are meant to be a means of exchange all across the crypto ecosystem. So, to have our first question today, what exactly is a stablecoin? So, a stablecoin is an attempt to create value to the crypto market without having a volatile price movement. The majority of them are pegged one to one with a fiat currency like USDT, aka Tether, which is pegged one to one to the US dollar. The majority of stablecoins are used for decentralized exchanges, aka or aka crypto only exchanges, where users cannot cash out their crypto for fiat, so they transfer their money back into stablecoins. So they are holding a lot of Ethereum on a decentralized exchange and they want to cash out, they will cash out for a stablecoin because decentralized exchanges do not offer ways to convert that money straight into fiat. Also, they're mainly a utility token. So stablecoins are mainly just to be used inside the ecosystem. They are not meant to be. You do not buy stablecoins because you believe they will increase in value. And also, they are price stable digital assets. So if you want a digital asset, if you want your money in the digital world without, like just like I said earlier, without having the volatile price movement, that is what a stablecoin does to offer. Also, it's pegged against fiat currency. So if you want something that's backed by fiat money, you would want a stablecoin. Also, they are designed to stay at a fixed value. That's why it is called stable, and they are secured via cryptography, just like any other cryptocurrency. They are secured just like that because they are stored on the blockchain. A list of popular stablecoins include not like these are in no particular order, just some very popular ones. And for the first one, we have USDT, which is Tether, which is backed one to one for the US dollar. And then we have USDC, which is the USD coin. And we have BUSD, which is the Binance USD coin, TUSD, which is the Trust token, and we have DAI, which is DAI, and that is also a very popular stablecoin. These are stablecoins for every currency, but the U.S. dollar is the main currency that stablecoins are created for. But be sure to do your own research before you purchase any stablecoins. So pretty much, what function, do these stablecoins serve? So obviously, stablecoins can help transfer money without the fluctuation of prices. So if you want to send your friend $50, if you send them $50 in a stablecoin, it will still be $50 in a stablecoin a month from now. They bridge the gap between fiat currencies and the crypto market because if you have a $1 bill, that $1 bill is always going to be $1, and the USDT token will always be $1 as well. They also provide a hedge against volatility in the market, because it will stay the same price. If the market starts to have a downturn, your crypto will stay the same price if it's all in stable coins. Also, the demands for stable coins are very high, so there's a potential to make an interest on loaning out stable coins in certain areas of the market. Just like I mentioned, you can land stable coins and make interest on them. You can do this on decentralized exchanges called like Aave, Compound, and Oasis. So obviously, I don't want to get into how you do that. That would be a later episode, and that would be a more in-depth episode of how to make money via stable coins. But that's just like kind of a broad picture. Also, many decentralized applications or dApps run with the use of stable coins. Um, Also, stablecoins can be sent over the internet very easily, kind of like a Venmo payment, but with crypto. And just like I said, you can pay a friend with stablecoins if you'd like instead of any other crypto. Say like you owe your friend $50, and you don't want to send them $50 in like Bitcoin because that can fluctuate up and down, and maybe you think Bitcoin's going to go up in the future. You can send them USDT, which will be $50 no matter what. So, how do you get stable coins? You can obviously earn them. You can get paid by a friend. Just they just transfer them to your wallet. You can also trade on decentralized exchanges and swap them and swap your crypto into many different stable coins. You can pretty much just buy stable coins off of a centralized exchange like a Coinbase or something like that, where you can pay money with pretty much. I've done this before, where on Coinbase I have paid $500 for $500 worth of USDC, which is the USD coin, and it kind of converts 1 to 1. It's just like a straight transfer, and then you can pretty much do whatever you want with that crypto from there. Also, uh, so let's say, for example, you buy $100 of a token like USDC. Say you want $100 in Tether. So you log on to Coinbase, you buy $100 in Tether, and then you transfer it into, let's say, your personal wallet because you don't want it on Coinbase. You can use this money on centralized exchanges and then transfer it to a decentralized exchange, like I just said, or you can transfer your stable crypto like ETH or BTC, for example, on a decentralized exchange as well. So if you have uh, Bitcoin or Ethereum in a decentralized exchange, you can transfer it into a stablecoin. Also, if you want to wait for a certain crypto to drop in price, you can transfer your money into a stable coin. And then once you feel like it has dropped in price and you're looking to buy, you can instantly swap your tokens for that cryptocurrency. Like, say you hold $500 worth of USDT and you are waiting for Ethereum to drop 10% before you buy. Once Ethereum does drop, you can instantly swap it, and now you own Ethereum instead of USDT. So like, who uses stable coins? And obviously, on decentralized exchanges, a lot of traders, especially crypto traders, will use these stable coins because traders are pretty much people that trade crypto at a fast pace, and they will need to swap between coins very quickly, and they will utilize the stableness of these tokens to they will swap say they make a trade for Ethereum, they'll swap it to USDT, which is Tether, and then they'll swap it to maybe Bitcoin because prices can fluctuate very fast. They don't want to swap it in between crypto to crypto. They want crypto to stablecoin so it doesn't drop or rise in price as they are trading. Also, many different exchanges really like stablecoins because they use stablecoins to attract users who have significant trading volume. So they are looking to attract many different people that will come onto their platform and trade a lot because of trading fees and everything. So they're offer a stable coin. Uh, they can offer a stable coin to attract a wide range of customers because everyone is able to understand that the stable coin will keep its value. Also, retail users use stable coins as well because they are a great store of value because they will keep their price. And also, they will use stable goods to purchase other crypto and many different services because a lot of countries, not really the US because we're kind of lagging behind in that department, but many Asian countries are using stable coins inside their economy to buy and purchase everyday items. Also, borrowers on decentralized exchanges will take out loans that is backed by crypto, and they will receive that loan in stable coins, which is really cool to see. So another question that a lot of people have asked is that what is backing the coins? Like, what's making the coin stay at maybe $1? So there's different many forms of collateral, and that's what's kind of keeping them that's what keeping their price stable. Sorry. And the first example is a one-to-one peg of fiat money to stable coins. And the greatest example of this is pretty much just Tether, which says it holds $1 for every Tether. It can also be backed by many different cryptos, which we'll get into in a minute. But so the pros of a fiat collateral peg is pretty much that it has the highest degree of certainty that it will stay at $1 because there is physical money behind the project. but there's a lot of scrutiny around one-to-one peg of fiat, especially with Tether. Tether's been in some hot water lately because of this. But the cons is that since the company owns like all the capital, it's frozen and they're not buying or like kind of they can't really access the money very easily because it is in fiat. Also, there's always the probability that illegal actions and the company going bankrupt or pretty much just stealing money. So, since the assets are not public, the company can always just lie about what they are doing with the one-to-one peg. Like maybe Tether just doesn't even have a one-to-one peg and they're just saying they do because it's not audited and it's not public. Just like I said, it's very hard to prove that the company actually has all the collateral it says it has. Examples of fiat collateralized stablecoins are Tether, True USD, Gemini USD, which is a stablecoin established by the popular trading forum Gemini, and it's actually run by the Winklevoss twins. And you have the USD coin, which aka USDC, which was issued by Circle and Coinbase, and you also have the DAI token. So you can tell that a lot of the most popular stablecoins are one-to-one fiat. And to move on to that, we have the algorithmic peg. Sorry, pretty hard word to say, but pretty much if it's a certain type of kind of like a smart contract where it will keep the price balanced due to the buying and sell orders. And pretty much if a bunch of people want to buy the stable coin, the price wouldn't rise because more coins would be created. So kind of like they turn the money printer on and send those coins to all the people that want to pretty much buy the stable coin. And if a bunch of people want to sell the coins, the algorithm would get rid of a bunch of coins to keep the supply stable. So pretty much everyone that sells, they would burn pretty much an equal amount, so the price always stays as close to $1 as possible. And just to reiterate, this is a algorithmic peg, and the pros are that no prior assets required for collateral, so the company does not have to have maybe like $1 billion worth of USD to run this, but it's pure based off programming. And the cons are that there are a lot of questionable skeptics all about if the algorithm will actually work properly due to a high influx of sell orders or maybe even the buy orders, that it can be depegged due to some kind of mishap. An example of this would be the Terra Luna madness and the crash. Feel free to look into that. It's a crazy situation with how Terra Luna kind of crashed after the depegging of their stablecoin. And the next type of collateral is called the crypto collateral. And pretty much this is where all the collateral is stored as crypto and can be seen on the can be seen by the entire community on the blockchain. This is pretty much just saying that instead of holding cash in a bank account, the company will have their stable coins backed by Bitcoin or a similar type of cryptocurrency. So, say there's like a billion, like let's say $1 million worth of a certain crypto, then it will be there. The company will hold $1 million in Bitcoin. A pros of this is that it's easy to prove that the company actually has the collateral needed because it is all on the blockchain. You can view the wallet and how much money they have that's behind the project. And on also the cons is that the collateral is very volatile since it's in crypto. So if you see a massive crash in crypto, that stable coin can have the risk of being depegged because if the company does not kind of keep that one-to-one peg, there can be some problems. And just like I mentioned, problems with stablecoins. Here are some kind of more issues in kind of like in the broad stablecoin kind of space. Is that there's no insurance with stablecoins, so it's not regulated like the FDIC bank. So in banks, when you store your money, obviously there's insurance up to a certain amount of money that is stored in the bank. But when you buy stablecoins, there is not the same amount of insurance. So if the company goes bankrupt, your funds have the risk of being gone. Also, there's a collateralization issue. So if Tether or another stablecoin is not backed one to one, it will crash, and so will your money. So your money is, even though it is called a stablecoin, there is still a risk of it becoming unstable. It's very hard to maintain the peg in the long run. The history of peg currencies normally doesn't work out. Example of this would be the gold standard, because normally economies will eventually kind of detach themselves from a certain aspect of like a peg or whatever because they want to kind of be able to control the money supply on their own. But I see stablecoins as something different because it is kind of proven with technology where it can be physically, where with technology it can be pegged one to one through like all the algorithms and kind of the one to one backing of the stablecoins. Also, since it is centralized, like a company kind of controls the stablecoin, some people get scared because in the crypto space it's supposed to be decentralized, and if it is centralized like a bank, people will kind of get scared and be worrisome of that it's not fully decentralized, and there can be some problems there. Also, users are scared about the possibility of regulation from governments because since crypto is new and so are stablecoins, people are worried about what the government can potentially do with the stable coins, and maybe they'll make a new law where stable coins are non-existent, and that would kind of crumble the decentralized exchange kind of world, especially with crypto. So that's it for today's episode of NFT Nation. Hopefully, you learned everything there is to know about stablecoins. And if you have any more questions, feel free to ask me a question in the Spotify poll or even shoot me a message on one of our many social medias. If you want to go kind of have or find out how to contact us, click on the link tree in the description and you will have many ways to contact us. You can send me an email. You can follow any of our social medias, which is at NFT_nation_podcast. And yeah, we're always open to any messages you all have. So feel free to send them in and we will respond. I just want to thank you all again for listening. Feel free to share this with a friend if you learned something. And if you did learn something, please leave 5 stars because it really helps Spotify know that even though we are a small podcast, people still enjoy our stuff and they're looking forward to our episodes all the time. So, yeah, that's going to be it for me today. Hopefully, you all learned something and have a good one, guys.